If something seems too good to be true, it probably is. And copy trading is no exception to that. Exchanges always love to show you copy traders making huge profits on the front page. They do that to lure inexperienced investors, with the offer that if you just copy this trader here, you will magically make 180% profit in just 30 days. And that's a very enticing offer. But as you'd expect, the truth isn't as straightforward as that. The truth is that when exchanges show you that amazing 180% profit, that is obviously not the whole picture. If it was, then nobody would ever work a day in their lives and we would all just be copy trading millionaires. But unfortunately, we're not. Although, at the same time, if it totally sucked, then no one would do it. So the truth must be somewhere between 180% and nothing. First, you need to understand how they get that number to begin with. You see, that nice percentage is solely based on realized profits. Trades that have closed in profit over that time period. It does not take into account unrealized losses, which are trades that are still open that are currently sitting at a loss. One of the main problems with copy trading is that you often end up sitting with a lot of unrealized loss. Because what most of the traders do is they try to cheat the system by using a very reckless trading strategy, but one that looks good on paper. What they'll do is they'll set up their trades with no stop loss, and then they use cross-margin mode, which basically means that each trade uses your entire copy trading balance as liquidity, as opposed to isolated margin, which most traders use, where the maximum amount you can lose from one trade is the amount that you allocate to that specific trade. But the reason copy traders use cross margin is they only use a tiny amount of the balance for each trade, which makes it very unlikely for a trade to liquidate even if it's at a significant loss. And since they don't set a stop loss, that means that the trade won't close unless the trader themselves closes it. Now, if you're making your own trades, you would always want to cover yourself with a stop loss to manage your risk. Especially if you're using cross-margin mode, since you can accidentally liquidate your entire account if something goes wrong. But the problem is, copy traders are very reluctant to close losing positions, since it shows up on their trading record, which the public can see. So they never want trades to hit a stop loss because that would look bad on them. So they use that cross-margin no stop loss strategy to make trades with a very small amount of capital. And they basically just hope that by leaving the trade open long enough, it will eventually turn positive in the long run, so that they can close it and have it look good on their track record. And that's why for most of the traders, if you look at their trading history, it looks like they hardly ever lose. But if you look at their open positions, they often have a huge list of trades that are currently at a loss. And a lot of those positions will have been open for weeks, if not months, but they're not causing enough of a problem yet for the trader to close them and have it look bad on their track record. Now, in reality, I'm not personally aware of a single profitable trader on Earth that can get away with trading the way that these traders do. It would be way too risky of a strategy. But they can get away with it, because the way they make their money is the commission from people copying them, not from the trades themselves. So they can afford to take a lot more risk because the commission from the copiers will cover their losses anyway, which is why it's in their best interest to make their trading record look as good as possible in the short term to attract a lot of copiers, even if it means sitting with a lot of unrealized loss, which is worse in the long term. And that's the most important thing to know about copy trading. The trader you're copying makes money regardless of whether you do or not. The more people copying them, the more money they make. So as long as they can make themselves look good on paper for a while by not closing any of the negative trades, that's enough for them to lure in new copiers with their seemingly amazing looking track record. But you often see their strategy fall apart the longer they go, because they accumulate too many losing positions, and what happens is they either end up liquidating the entire account, or they just have no capital left to open new trades, because it's all tied up in these losing positions. And that can turn into a downward spiral in itself, because the less spare liquidity they have, the less they have to cover the losses that they're already incurring. Now, as for what profit you can realistically expect if you do copy one of these traders, personally, I've had mixed results with it. In my experience, it's usually not too profitable in the short term, but then as you get into the midterm, it becomes more profitable. But then in the long term, it's very inconsistent. Some months I've ended up taking a 30% profit and thinking, oh, this is great. And then the next month it's a 20% loss, which isn't great. Another big problem is actually a lot of YouTube videos that you see talking about copy trading aren't really showing you the whole picture, and they're just as bad as the traders themselves, because all they want to do is show their exchange referral link to you so that you sign up and earn them commission. So they usually end up dressing up copy trading as some get-rich-quick scheme, which I think we've established by now it is obviously not, but the truth is, and you've probably figured this out by now, most crypto YouTubers have absolutely no morals whatsoever. Now look, I'm not going to sit here and act like a bit of shilling is below me. In fact, if you do want to try out copy trading, you might as well sign up to the Big X exchange using my referral link in the description for a 20% discount on fees. I mean, come on. But at least I'll be honest with you and tell you that in my experience, the results have been average at best. My advice if you do try it would be to try and look for a trader who uses isolated margin as opposed to cross margin, and ideally doesn't have a load of losing positions open. You can usually check that on their profiles. So all said and done, is copy trading a scam? No. It is often possible to make some money with it, just not as much as people would have you believe. Now, are the traders using shady tactics and reckless strategies to improve their short-term track record? Absolutely. The game is the game. Now, if you want to know how CoinMarketCap is scamming their users, go ahead and check out this video, or this other one that YouTube recommends. I've been me, you've been you. Thanks for watching, and see you later.